The current live price for Plug Power Inc. on the NASDAQ, under the ticker PLUG, is trading around $2.01 per share, reflecting an intraday gain of approximately 1.5% as of this morning's session on December 1, 2025. This move is relatively modest in the grand scheme of the stock's recent volatility, but what is far more telling and unexpected is the quiet, almost overlooked, restructuring of the company's balance sheet that has just occurred. Most of the market conversation, particularly on retail forums, is fixated on the constant shareholder dilution and the unending need for capital, painting a picture of a business perpetually on the brink. However, the recent completion of a convertible note offering that netted roughly $399 million in cash was strategically used to retire a significant chunk of high-cost 15% debt and refinance other notes, which is a key technical event that fundamentally improves the cost of capital, despite the immediate fear of future dilution. This tactical financial maneuvering, reducing the punishing weight of high-interest obligations, is the true insight the market is currently underappreciating, and it sets the stage for a much clearer path toward operational profitability, even if that path remains long and arduous. The expectation narrative around Plug Power, which dominates platforms like Reddit and X, is a classic high-growth, high-burn story, a company with massive potential in the green hydrogen space, constantly held back by enormous losses and a cash furnace. Investors see the company building the entire hydrogen ecosystem, production, liquefaction, delivery, and end-use fuel cells, and they are captivated by the long-term vision of a world powered by clean fuel. Yet the reality has been quarter after quarter of disappointing gross margins, operational losses, and a share price that has fallen more than 50% from its 52-week high of $4.58. The market is struggling to reconcile the compelling story of building the backbone of the hydrogen economy with the harsh financial data that shows the company losing significant amounts of cash the more revenue it generates. The third quarter results were a perfect illustration of this tension, with revenue up only marginally year over year, yet net losses ballooning to over $365 million for the quarter alone. The company is in a scaling race, attempting to drive down the cost of green hydrogen production faster than it runs out of working capital, a race that most retail investors have watched with understandable anxiety. Looking at the recent stock movement, the current slight uplift is a small rebound following a significant period of selling pressure that saw the stock dip back toward the lower end of its recent trading range. The price action is incredibly sensitive to news about capital raises and financing, as evidenced by the sharp drop following the announcement of the convertible notes, which, while beneficial for the debt profile, signaled future share dilution, thus punishing existing holders. Institutional flows have been a mixed bag, but the recent capital raises suggest that the company's need for cash is a real overhang that sophisticated players are pricing in. The average daily volume, while still substantial, has moderated slightly from the frenetic levels seen during the major upward swings in the prior months, suggesting that some of the speculative heat has temporarily left the name, leaving behind a core of dedicated long-term believers and a large contingent of short sellers. This brings us directly to a crucial component of the current trading environment: short selling activity. Plug Power is, simply put, a battleground stock, and the short interest is elevated, making it a prime candidate for volatility. The latest available short interest data shows an extraordinary number of shares held short, in the ballpark of 305 million shares. When you compare this to the company's float, the short interest percentage of float is running north of 23%, which is a seriously high level that indicates a strong coordinated conviction among short institutions that the stock is fundamentally overvalued and destined to fall further due to the relentless cash burn and dilution. The days-to-cover ratio, which is a measure of how many days it would take for short sellers to buy back all the borrowed shares based on average trading volume, has been fluctuating, but hovering above 2.5 days to cover is a notable signal. A ratio above 2 is often seen as an indicator of potential for a short squeeze, should a sudden positive catalyst force shorts to cover their positions quickly. Short sellers, including notable firms who track unprofitable green energy ventures, are primarily operating on the thesis that Plug's production costs for green hydrogen cannot reach parity with gray hydrogen quickly enough, leading to gross margin compression and continued massive losses that will necessitate further punishing stock offerings. They point to the company's recent decision to suspend activities related to the Department of Energy loan program for 6 hydrogen plants, reallocating capital toward a pivot that involves monetizing electricity rights for data center buildouts, a temporary pivot toward the white-hot artificial intelligence power demand as a sign of financial distress and shifting strategy, a signal that the core hydrogen plant buildout plan is struggling. Investors should monitor the short borrow fee rates, which, while still relatively low, can spike rapidly if demand to short the stock increases dramatically. An aggressive spike in the borrow fee, coupled with high trading volume on an up day, is a clear sign that a short covering rally might be in progress. For retail investors navigating this environment, the actionable insight is to find reliable short interest data directly from NASDAQ or an equivalent service, and to avoid chasing volatile upswings driven purely by the hope of a short squeeze. These events are fleeting and difficult to trade profitably without professional tools and leverage. Remember, the short thesis is simply the professional counter-argument to the growth story, and both must be respected. Do you think the government will pass additional production tax credit legislation in favor of the clean hydrogen industry anytime soon? Or is the current support enough to sustain Plug? Comment below with your thoughts on that key regulatory risk. The core of Plug Power's business is the development of a vertically integrated green hydrogen ecosystem. This involves manufacturing polymer electrolyte membrane, or PEM, electrolyzers used to produce green hydrogen from water and renewable electricity, operating liquefaction plants, and deploying their patented GenDrive fuel cell systems in material handling and stationary power markets. Their fuel cells are primarily used to replace conventional batteries in EVs like forklifts in massive warehouse operations for companies like Amazon and Walmart. Their pitch is simple. Hydrogen fuel cells offer faster refueling and consistent power output compared to lead-acid batteries, leading to higher efficiency in logistics operations. The older reports show that this material handling segment has been their most consistent revenue stream, but the real perceived value and the source of the market's high hopes lies in their electrolyzer and liquid hydrogen production capacity, which positions them as a foundational player in the broader industrial decarbonization trend. Their future outlook is entirely dependent on 2 critical factors: the timeline for achieving operational efficiencies at their hydrogen production plants, and their ability to secure large, stable contracts that can lock in revenue and scale their distribution network. The recent announcement to monetize electricity rights for data center buildouts, a temporary pivot toward the white-hot AI power demand, is an unexpected potential catalyst to inject much-needed near-term cash flow while the green hydrogen infrastructure matures. If Plug can use this cash bridge to further optimize its Georgia and Tennessee production facilities, showing clear progress toward positive gross margins on hydrogen production, it would fundamentally exceed the market's current low expectations. The risk, conversely, is that this pivot distracts from the core buildout, or that the market views it as a desperate move, confirming the short thesis. The upcoming special shareholder meeting to approve doubling the authorized share count from 1.5 billion to 3 billion shares is a clear, tangible risk of massive future dilution. This is the reality check that forces investors to ask if they are buying future growth or simply funding ongoing operations. Investors should monitor institutional F-13 filings closely over the next quarter to see if major funds are buying the latest debt refinancing dip or if they are trimming their positions ahead of the dilution vote. The tension between expectation and reality is stark with Plug Power. The expectation is that they are the pure-play hydrogen giant that will dominate the clean energy space, a view that is fueled by grand announcements and a massive addressable market. The reality is a company that is currently a financial strain, heavily shorted and whose short-term price action is dictated by its critical need for capital. The stock is deeply speculative, a position in the future, not the present. The recent capital raising was a defensive move that bought them time by reducing a painful interest expense burden, a crucial step toward meeting the reality of their operational goals. This is not the clean takeoff many expected, but a messy, hard-fought, grinding path toward financial stability in a developing industry. The core takeaway remains that while the vision is compelling and the market opportunity is vast, the stock price will continue to be chained to the company's quarter-to-quarter ability to manage its cash flow and demonstrate a visible, albeit long-dated, timeline to sustainable profitability. The coming months will be defined by the market's reaction to that dilution vote and any further news on their data center power strategy. What's your take on the rising